here for you today. One is Joe with the Polsinelli Law Firm. We'll be talking about what it's like on the contract side, what customers are looking for, those type of things, as well as Greg with Ameren, who will be talking about some work that Ameren's putting together around this particular topic. Both very interesting, and I think connected well to what pardon me, we just heard. So with that, I'd like to kick that off and have Joe start us up. Joe, are you there?
I am here. Can you hear me?
We hear you, yes.
So my computer is telling me that the host has stopped my video.
Okay. He might be just transitioning here.
Here we are.
There we are. Okay.
Fantastic. All right. Well, thank you very much. And Josh and everyone, I really appreciate the opportunity to be here today. These things were definitely more fun when we can actually see a room full of people and talk, but great to be here virtually as well. So just a quick note about my background. I'm not primarily an energy lawyer, primarily a derivatives lawyer. So I work in contracts that settle financially, that reference things that happen in the real world, and those are done for various purposes. And I know one of them, which I think is very, very interesting, is the virtual power purchase agreement. So, you know, what does that mean for the PPA, the power purchase agreement, to be virtual? That means that it takes place entirely on paper and in bank accounts. And in a legal contract, the seller, the place that power is actually generated, still sells its power that it physically generates into a grid. It receives the market price for that power, and the VPPA buyer, who generally is a user of power, is still buying physical power from its own grid. But there's this contract struck between the two where they agree on a strike price for that power, and then the buyer receives power when the market price goes above that strike. The buyer receives payments when the market price goes above that strike price, and it makes payments where the market price goes below that strike price. So it's allowing the transfer of exposure to the market price of power from the facility that's actually generating it and the developer to the buyer. And we'll talk about why that's being done on the next slide. If you could advance one for me, please. So here's just like a very simple diagram of the ecosystem in which the VPPA is used, and unfortunately I don't have pointing mechanisms, so if you see me pointing at my screen, just know that that's what I'm trying to convey. So in the center of this diagram is the facility. So this is the renewable energy facility where power is actually being generated, and what it's doing is it's capturing electricity in some way and sending that power to the grid that it's connected to, and receiving the market price. That facility has been developed by the sponsor, which is the box above, and it's been developed with the use of investment capital from tax equity investors who are primarily motivated by the receipt of tax credits that can offset their tax obligations from their other businesses. And then that investment capital is paired with debt financing from a lender who allows that the procurement of leases and equipment and the creation of a facility to be financed. If you just look at that right side of the screen, The problem that you have is the facility is going to be generating power and selling it into a grid at a variable price. And so the amount of revenue coming into that facility is going to vary with fluctuations in the market price for power. From the perspective of the lender and the investors in that facility, that creates a concern, because what if the price of power goes sharply down? That facility may not have sufficient revenue coming in to allow it to make its debt service obligations. And so that's where the VPPA comes in from the perspective of the developers and the sellers of power. The VPPA buyer is traditionally a high credit corporate who agrees to enter into the VPPA, which is a longer term contract, generally like 10 or 15 years, and pay a fixed price for at least synthetically all the power that is generated by this facility during that term. So that on the right side of this diagram, the lender and the investors know that there's going to be a fixed price coming in. So even if the price of power goes way down, there should be enough money coming in to allow that facility to continue to service its debt obligations. So you'll see, if you look at all those arrows, you'll see that the facility is receiving market price from the grid, but then it's paying the market price to the VPPA buyer, and the VPPA buyer is paying a fixed price. So on a net basis, the facility is receiving that fixed price that it's agreed to in the energy. It's locked in the receipt of those funds. From the buyer's perspective, so the left side of the screen, it is a consumer of power from the grids that it's connected to, and is paying the market price for that power. When it enters into a VPPA, from its perspective, the perspective of the buyer has then hedged to the extent of the VPPA its price risk associated with the purchase of the power. So there's that symbiosis where this structure works from both parties' perspective. Can you advance to the next slide, please? So just a quick note about current developments and local considerations. A huge benefit of the VPPA is that if you're a big corporate and you want to get this hedge and you want to participate in renewable energy generation, you can't unplug yourself from one grid and plug yourself into another one, obviously. So what you can do is continue purchasing the physical power that you have been purchasing, but enter into this virtual power purchase agreement. And since it's just something that operates over a legal contract and bank accounts, there's no requirement for co-location. So a buyer can enter into a VPPA, across the country or across the world, although it wouldn't be as good of a hedge. So there's no co-location requirement, which makes this a very flexible and usable product, because the developments happen where they happen, and the corporations have their power usage where they have it, and the VPPA allows the bridging of the gap. And we've seen continued development in Kansas and Texas and elsewhere, where developments are occurring and entering into VPPAs with corporations primarily on the West Coast or wherever. So this solves that co-location problem. If you could go to the next slide for me, please. The next thing I want to talk about is just so as a lawyer, what I'm primarily dealing with is the nuts and bolts of this contract. Excuse me, how it works, and how the parties to that contract protect themselves from bad things that could occur based on bad incentives or unexpected events. So at just like a very high level, if you were looking at a term sheet for one of these, the contract terms that you would see is, one, what we call in the derivatives world, a notional amount. So this is the amount of power generation that is being covered by that VPPA. And depending on the project, there may be one buyer that's off taking the entire generation capacity of that facility, or there may be a syndicate of buyers where each one is buying a portion of that facility's generation. But the notional amount tells you how much of the generation of that facility is embedded in this particular contract. Next key term is the fixed price that would be paid by that buyer to the seller in respect of that in respect of that contract, and that is essentially a market price for that's determined by this ecosystem, the amount of development that's occurring, and the demand by VPPA buyers for taking this position in a development, and that has this competitive market that is developed to determine fixed pricing for VPPA contracts. And buyers and sellers will go through formal and informal mechanisms of sorting each other out, trying to find a market price and trying to find the optimal price available for the type of transaction they want to enter into. Next is the spot price. So that is the market price at which power is actually sold into the grid by the facility. And the fixed price, right there in the name, it's fixed for the term of the contract, although some contracts it may gradually step up. But the floating price, floats up and down with the price that is obtained by power purchases over the grid, and usually within the mechanism of a contract, it's averaged over some period, generally a monthly period. So buyer is long the power in the sense that it will receive payments if the price of power goes up, and it will make payments to the facility if the price of power goes down. And can we advance to the next slide, please? So this is just a visual of what I just described. If you think about the jagged line as being the market price for power as a function of time, it goes up and down, during the day and over longer term periods based on market forces. And when that red line that's dividing the blue and the green is the strike price. So when that price of power goes above the strike price, that's the point where the seller, the facility, is paying the buyer. And when it's lower, when the price of power is depressed, then the buyer would be paying the seller. Next slide, please. So this is just a simple numerical example of that. Again, if you have a fixed price of 15, if the price of power goes up to 16, then the buyer is receiving $1 per the unit of power transferred by the VPPA. And then in the next month, if the average price is going down to 13, then the buyer is paying in $2 times the amount of generation capacity that the VPPA covers. Next slide, please. So one of the most important parts about the VPPA is the credit terms. What you have, as I mentioned before, is a longer term contract, 10 to 15 years. And you certainly have projections as of now about what the price of power is going to look like over that term. But projections are what they are, and the world can change drastically versus what we expect at the point at which one of these is signed. So in a longer term contract where you've locked in a fixed price, once significant changes in expectations happen, there can be a very significant value change to that contract. That contract could be, if prices have depressed significantly and they're expected to stay that way, then the VPPA as a receivable has very significant value for the facility. And from the facility's perspective and the lenders and the equity investors' perspective, they want to make sure that the buyer has the credit capacity to continue to perform so that they don't lose the value of that contract. So what you see is buyers that are very creditworthy, have a high credit rating, or conversely buyers that have borrowed a credit rating, who have procured a letter of credit be delivered in connection with the VPPA, to ensure that from the facility to the lender's perspective that buyer is going to perform, that it's going to continue paying the fixed price over that term, even if the value of energy has gone way down. Can we get to the next slide, please? So yeah, here's the most common means of creditworthiness are ratings. You know, that corporation has a high credit rating, and again, if it doesn't, it may also post collateral, cash collateral. It may have a guarantee from another creditworthy entity, or probably most commonly a letter of credit from its bank, allowing the facility to be confident that the buyer will continue to perform. And the amount of that collateral, the amount of that letter of credit, and limitations of liability are some of the significant credit terms that get negotiated when these are being signed up. Next slide, please. Along with the transfer of the market price of power, the other important thing that's happening here is that the facility is, you know, maybe generating renewable energy credits in association when it generates physical power. Those renewable energy credits aren't required to be transferred along with the market price of the power, but they generally are in VPPAs, and that allows the buyer to take those renewable energy credits and retire them and claim that it is using renewable energy, even though it is in actuality connected to a grid that may or may not be renewable energy generated. And then those credits have some cash value, but generally what we see is the corporations using those to claim compliance with requirement or to claim some that they're meeting some renewable energy usage standard. Next slide, please. So the next couple slides, we're just going to very quickly talk about the some of the contract risks that we run into that you know, come up in derivatives contracts broadly, and in particular in VPPAs. The next slide, please. And before we get to that, something to keep in mind is that this is now post the enactment of Dodd-Frank in 2010. Anytime you're synthetically transferring an underlying exposure, you have what is called a swap under the Dodd-Frank Act, and it's subject to various regulations, including in particular reporting of transaction information to the CFTC or repository maintained that the CFTC has access to. So when negotiating these contracts, it needs to be kept in mind that there are accompanying regulatory obligations in addition to what you would traditionally think as regulatory obligations with respect to power generation. You're not generally thinking about swap regulation, but that is an aspect of the VPPA that needs to be kept in mind. Next slide, please. Okay, the last thing I was going to say, and I think I may have dropped it just in terms of time, but the things that we think about when we negotiate them, the things we try to protect clients from is anytime you're doing a synthetic contract, you're looking at some reference price. So the price for power at a certain point on a grid. And you're subject to changes in the way that that market price is calculated, and you're subject to the potential for manipulation. So we always want to be sure that our clients are as protected as possible with respect to those possibilities. And also the facility is in control in some sense of the amount of power it is generating. In terms of downtime and speed to completion. And so the contract needs to think about the incentives that each party has and make sure that the other parties are protected from those incentives, and that either primarily the facility, since it's in control of the generation, that it can't run that facility, in a way where it is optimizing the amount of money it receives from the VPPA to the detriment of the buyer. So that was my high-level summary. Looking forward to any questions folks might have about those nuts and bolts of the contracts.
Thank you so much, Joe. Definitely a detailed or technical topic that we're trying to deal with here. So thank you for that run through. Before we get to questions, we're going to go to our next panelist, Greg, with Ameren. Greg, I'm going to hand it over to you.
Okay, Josh, thank you. Are you able to hear me?
Fantastic, yes. Okay,
perfect. So good morning, everyone, and thank you for the opportunity to present another option to meet customer sustainability goals. I'm Greg Lovett, as Josh mentioned, and I lead Ameren Missouri's customer-facing renewable energy programs. It's an exciting time to be in the renewable energy space, and Ameren has a plan to accelerate the transformation to renewable energy and partnering with our customers to provide them with local renewable solutions. So I want to go through, some of those right this morning. So next slide, please. So let's first start off with a little bit of what a green tariff is. It's an electricity rate offered and operated by utilities and approved by state utility commissions, which facilitates renewable energy and renewable energy credits procurement by customers. There's basically three different models that's being used out there today. One is a sleeve PPA, where utility serves as the intermediary to facilitate customers to contract with the PPA with a renewable energy project developer. There's also a subscription program where the utility secures renewable energy resources and allows multiple customers to subscribe to a portion of the supply generated by the renewable energy project. And then there's a market-based rate program where the utility provides access to the customer to wholesale markets to facilitate the securing of renewable energy. As seen from the U.S. Green Tariff Deals chart, these programs really started to accelerate in 2017 and spiking in 2018. The full 2020 numbers are not reflected in this chart. Also, the programs are in various stages across the nation. When this map was put together, Missouri has green tariffs that are available. The Missouri PSC approved a market-based rate program for Ameren, Missouri back in 2018. However, an agreement with the developers at a price and an appropriate risk for the customers has not been reached at this point. Next slide, please. So we've been talking to our customers to see what type of utility green tariff program would work for them to meet their sustainability goals, which are associated with the energy that they use. Here are some of the typical components of a subscription-based utility green tariff program. Most customers are not familiar with energy markets, and they are looking for a simple and transparent program with known credits and charges. Customers want renewable energy credits to document their actual participation use, their rate. Customers are also looking for projects that support the local emissions and local economic improvements rather than projects several states away. Participating in a program like this is simple to understand and manage by the customer. Customers like the benefits of partnering with the local utility who they have been working with for years. The local utility can also provide a diversified portfolio of renewable resources as part of the program to minimize the operational risk rather than one single project. The local utility can also, all of the costs of the program are included in a tariff which has been approved by the State Public Service Commission. There are no regulatory requirements that the customer has to secure. The local utility has also been providing service to the customer for many years, which supports the financial credit requirements. As you can tell, the local utility is really focused on customer satisfaction and want to provide their customers with a hometown option. An additional benefit to the subscription-based renewable energy program is they support customer affordability, where non-participating customers are not paying for the additional resources. Next slide, please. On this slide of the chart, I provided a comparison of the typical utility green tariff subscription program components to a typical VPPA program. I'm not going to go through each one of these components. Joe just previously described a VPPA. But as you can see, customers need to be aware that there are risks in market-based price. There are several uncertainties associated with VPPAs and may not support the local economy and environment, and there are also possible hidden costs. In addition, not all customers may be large enough and able to participate in a VPPA. The main point on this slide is the customer has to understand all of these components and that price is not the only thing to consider when selecting a renewable energy program to participate in. Next slide, please. Ameren, Missouri filed our 2020 Integrated Resource Plan with the Missouri Public Service Commission at the end of September of 2020. The IRP included a much more aggressive generation resource transformation to renewable energy over the next 30 years than what was presented in the 2017 Integrated Resource Plan. As part of this preferred plan, I want to focus on the short-term customer-facing renewable energy programs and how these programs are integral to and accelerates the plan. The filing of these programs shows that we are committed to fulfilling the transformational plan. Next slide, please. So now I want to focus on, like I said, focus on the short-term plan in 2024. We have 900 megawatts of new renewable energy is planned, of which customer subscription program is a major contributor to the 900 megawatts. A variety of Ameren, Missouri's customers, from residentials to large industrials, are requesting access to 100% renewable energy prior to Ameren's traditional transition plan. Many of these customers are willing to pay a premium to gain access to cleaner energy and are considering a variety of paths to achieve their goals. In October, Ameren, Missouri filed a certificate of convenience and necessity to build a 6.1 megawatt solar resource for our community solar pilot program, which has been expanded from the 1 megawatt that's already in place. Today, we have over 2,000 subscribing customers on the wait list to fulfill this resource, which is 98% filled. We are excited to be able to provide these and future customers with renewable generation. Green tariff programs. Like I mentioned, we've been working with major customers with sustainability goals that are consistent with the Renewable Energies Buyers Alliance guiding principles. And as one step to meet the business customers' needs, Ameren is developing a new subscriber renewable green tariff program. In fact, in September of this year, Ameren, Missouri filed a notice with the Missouri Public Service Commission that it will file for approval a voluntary subscription-based renewable program. At this point, both wind and solar are being considered to support the program and is expected to include several hundred megawatts of new renewable generation capacity. Barring unforeseen circumstances, Ameren, Missouri intends to file this green tariff program in early 2021. It will take time to get the program approved by the Missouri Public Service Commission, and then the construction of the new renewable resource. And so we're acting now to meet our plans for 2024. Next slide, please. This was, a very brief but very important message that I wanted to get across, that customers do have alternatives and local alternatives. So I want to thank you for your time today, and we're really looking forward to partnering with our customers to bring renewable resources to Missouri. Thank you.
Thanks, Greg. Joe, if you want to hop back on, just a reminder to everybody, please use your Q&A on the upper right to ask any particular questions you may have of this panel. I don't see any right now, so I'm going to kick it off and wait till we get one. I guess, are either of you aware of an entity that has utilized the VPPA in Missouri?
So in the Kansas City region, we have assisted with a VPPA buyer.
Okay.
So, and it's because of that lack of a need to be co-located with the facility. It's just there's a national market for these products. There's developers who want to find off-takers for facilities, and the geographic location of the buyer really becomes not relevant. It's really just about what are their power needs to hedge, what is their expected benefit in terms of the present value of the contract to them based on the market strike price, and do they have the credit ability to enter into that contract. But yes, so at least one local buyer.
Okay. We do have a question from Andy Knott, and that question is, will the new green, and this is for you, Greg, will the new green tariff proposal that Ameren will file in early 2021 add to the clean energy planned in its latest IRP, or are those megawatts already included in the IRP?
So the 2020 IRP plan, the plan that was selected, includes the integration of the subscriber renewable program. So it will not be in addition to, but what the plan shows is inclusion of the subscriber renewable program.
Okay. And I might have missed this. For both of you, for Greg, for your subscription programs and your other offerings that you either have developed or are looking to develop, is there a contract that is specific to length? And then Joe, that's to you as well for the VPPAs. Are they specific as to how long they typically last? So, Greg?
Yeah, so for our community solar program, which we already have, 98% subscribed of our new resource, there is a 25-year contract. However, there is a clause in the contract that if there's customers on the wait list to take the customer's place after 2 years, the customer can drop from the program. The new subscription based program is, yes, there will be term lengths associated with it, yet to be developed. Actually, it hasn't been fully determined yet, but there will be contracts links.
Okay.
And that's the case for the VPPAs as well. One of the key terms is that this is a long-term fixed price contract. So from the seller of power's perspective, for that term, it is subject to the possibility of the buyer failing to perform. But for the term of that contract, it is locking in that market price. And so what we typically see is 10 to 15-year terms that gives the lender to that development and the investors comfort that at least for that period of time, that 10 to 15 years, that the facility has locked in the amount of money it's going to receive in respect of the power that's being generated. And from the buyer's perspective, it's to the extent it thinks there's value in the contract it's entering, that longer term, allows it to recognize value, especially if generation, the price of power at the relevant market goes up over that period. So from both parties' perspective, it's important that there be a long-term obligation and that term is fixed by contract.
And is there a traditional, is it 20 years, 30 traditionally?
I haven't seen them that long. It's hard to, I think over that term, it's hard to evaluate the credit of a buyer over that long of a term, and also the continued generation capacity of the facility. So we typically see 10 to 15 years.
10 to 15. Okay. Greg, there was a follow-up question from Andy, and that was, will municipalities be able to subscribe to your new green tariff?
Most definitely. It will be open to all business customers, of which municipalities are a major player for us, and they're very concerned about green renewable resources, and do they want to be have something local? So most definitely municipalities will be able to participate.
And in Greg's presentation, and I mean even somewhat underlying in yours, Joe, there seemed to be a type of client that fits the VPPA's usefulness as compared to someone else. Could you talk a little bit? Is there a specific type of customer that does fit, or if you have, it's a better or easier description of that doesn't fit a VPPA? Is it just size? Is it just those looking to save money, or a much larger corporation that can spread it out throughout facilities? Is there any type of string that connects it all?
Well, so I would say from my perspective, size is the most important thing. If you think about a developer who is putting together a project, they need to negotiate with off-takers of virtual off-takers of the energy that's going to be generated, and that we haven't seen that process take place where the developer is going to sell to hundreds of smaller companies. Generally it's one off-taker or at least on the VPPA side, one big corporation that's taking the entire generation capacity, or kind of a small consortium. And that's partly due to the complexity of negotiating the contracts and the inability to do that with a crowd. I think even if you have a consortium of 4 or 5 companies, it becomes very difficult in negotiation to accommodate everyone's interests. But also, from the facilities, as I've said, a couple times, from the facilities and the lender's perspective, what's really important there is the credit. You want to know that over that 10 to 15 year term, that someone is going to be good for that, for the continued payment of that fixed purchase price. And so if you're a smaller entity, you just may not have that credit standing. You may not have a way to get a letter of credit large enough to make that make sense. So that's what we've seen on the VPPA side. And it's a somewhat difficult and expensive undertaking to negotiate one of these, just because it's a detailed, complex contract, and it's they generally go through extended negotiations, and it's not something that, you know, all businesses have the wherewithal to do.
Great. Well, that is all of our questions. I don't know, Joe or Greg, is there any last statement you'd like to make?
You know, I was going to add, and I think this is just true across the board, that when we think about the prevalence of these, it's dependent on, you know, the cost of renewable energy generation and the value of power that's sold into the grids, but also the ecosystem really revolves around the tax incentives currently. And so the trajectory of these contracts and the developments that they relate to are going to be very dependent on tax policy, as well as the value of the renewable energy credits that get generated. So, you know, whether the wind and solar investment tax credits get extended or changed in some other way, and also you know, those tax credits have value in relation to the amount of taxes that businesses are paying, the businesses that would invest as tax equity investors in these projects. So whether the corporate tax rate changes from what it currently is, you know, obviously has an effect on the value of those credits and therefore the viability of these projects. So it's just an ecosystem that is very highly dependent on tax policy, and we have an incoming new administration, though not uniform power across Congress. So how that develops in terms of how these renewable energy policies shake out will obviously have a huge effect on the prevalence of these contracts.
So, Josh, you know, just wanted to kind of wrap up from Ameren Missouri's perspective is that, you know, our customers are asking for renewable energy solutions, and you know, we want to be able to offer all of our customers a way to participate in our programs. And you know, so you know, it's good for, you know, our local environment, it's good for local economy, it's good for the subscribers, and it's good for our non-subscribers. So it's just a win-win for, you know, everyone. And we're really excited and committed to be able to offer a solution for our customers. So thank you for the opportunity again, Josh, for allowing me to, you know, describe our programs.
No, I appreciate that. Appreciate your participation, Greg. And actually, Greg, there was one other question, and with typing it makes it longer, so we're going to go ahead and take it. And that was from Tim Michaels. It's is there an actual premium paid relative to the current rates over the 25 years, or does this reflect the current market costs of solar being less than coal and natural gas levelized costs of power? Or is the relatively small scale of 6 megawatts such that the economies of scale haven't been realized?
So for the approved tariff, yes, there is a premium for this program. Customers are, you know, getting a premium product, and they're getting the renewable energy credits associated with that. It's, you know, for typical customers, it's $3 to $5 extra a month. And, you know, and that's all written, you know, upfront, described in the information provided on our website about the program. But yes, there is a premium for the customers. And yeah, you know, a 6.1 megawatt is not getting to scale yet. You probably don't start seeing that till you get up, you know, a much larger utility scale, you know, maybe 50 megawatts or something like that. So there's still a room to continue to grow this program. And that's the intent, is to continue to grow this program, because, you know, we only have, you know, a little over 2,000 customers participating, and, you know, we have around, you know, 1 million customers total. So a lot of room yet to expand.
Well, Greg, thank you very much for that. Joe, thank you as well. Hope you both have a great rest of your week, and hope you'll be able to stay on and participate in the upcoming sessions. So as we transition over to the next session, I wanted to say at this time tomorrow, in the